So my name is Craig Dyer, Head of Capital Markets and co-founder of HECTO. So the topic today is bringing the wealth on-chain. Challenges and benefits for professional investors, opportunities for retail, and trends. So we're no longer really at the experimental phase of tokenization. We're now very clearly at the implementation phase. We're seeing trillions of dollars of real-world assets going on-chain. At HECTO, we're at the forefront of that. We are currently tokenizing an index of pre-IPO companies. Think of the likes of SpaceX, OpenAI, ByteDance. We're bringing that on-chain. So to help us today, we have our esteemed panel here. I think I'll let them go through and make their own introductions. Peter, do you want to start?
Absolutely. Hi, everyone. Nice seeing you all here. My name is Peter Kadish. I am an example, represent a company that is an example how business that is operational with track record and institutionally set up is creating a product which is being offered on-chain.
Hi, I'm Florian. I'm the founder and CEO of a company called Evident. We've been around for a little while and started tokenizing private investments. So everything from private equity, secondaries, pre-IPO deals, to private credit investments, to infrastructure investments, all the way to collectibles, all the way to specialty assets, as we call them, like Pikachu cards. This is the most in-demand asset class for private wealth investors. So our clients are mostly traditional clients, family offices, private banks, digital wealth platforms, and now also licensed, say, crypto exchanges who can list securities. So the thesis is very simple, that all of these assets, of course, will move on-chain. We'll stop using paper contracts, PDF, phone calls, email, meetings, and of course, it will all be electronic trading of private markets. So we build on that thesis, and I would say last year you could really see product market fit in this industry, and this year is all about growth.
Gillian here. So I'm the founder of Mulana VC and Mulana Investment Management. Mulana IM is licensed by the SFC, holding type 1459 license or upgraded to handle crypto assets. Under type 1 license, we have been helping with a number of issuers to secure SFC approval to issue registered security based on real asset security tokens. So happy to share our experience here later.
Good afternoon, everyone. This is Ray. So I'm the CEO of Revo Digital Family Office. Revo, it's a subsidiary of Revo's family office that dedicated into digital asset management. So we provide wealth management solution across the whole Asia, for all the high net worth individuals on wealth management. So we do headquarters in Hong Kong, Singapore, rep office in Taipei, Shanghai, and Bangkok. So happy to share more later.
Thanks, guys. So let's start by talking about the trust hurdle. This is one of the key topics, I think, about coming on-chain. We often say that blockchain replaces blind trust with actual mathematical proof. In your specific sector, what's the biggest remaining trust hurdle that you're seeing that's keeping institutional capital on the sidelines right now? Peter, do you want to kick us off?
Sure. It's an interesting discussion, hopefully, because we represent, let's say, different sides of the business. We are an investor, so we're looking to capital to be deployed, and colleagues here on the right, they represent, let's say, they're gatekeepers to this capital. So it's maybe more appropriate question to them, but I'll nonetheless will tell you our experience and what we see. In terms of real-world assets, our experience and my personal opinion is that there is a reason why mostly we're talking about U.S. Treasuries, which are, constituting to the majority of real-world asset. And this is lack of projects which will be validated and onboarded and presented by the gatekeepers. I think it's, as far as I can tell, also from the previous panel, we are generally in agreement that a lot of stuff which is not successful or just a startup in the real world, these investors are looking for capital on-chain. So they're bombarding you guys with all this. And for you, it's very difficult to understand where's the value and where there's no value. From the perspective of capital raising, we're funding to 98% currently in the real world corporate bond market. We have a placement agent, so that this business is clearly understood. It's about knowing the issuer, it's about checks and balances, audited account, security agent, all these elements which are market standard for institutional investors to be comfortable with placing the money into the project. And then the same will be done by the asset managers, but that takes time. They have so much, assume, interesting to hear of different projects that are being offered. And you have to do basic elements of due diligence according to the market standards. So the capacity constraint is there, specialization. Some platforms are not having the background of and capabilities of doing this due diligence. It's a problem. So basically, it's the shop that offers for sale everything, right? And they are, well, not intoxicating, but I don't think this is scalable. But yeah, interesting to hear what you're going to say about your experience.
Yeah, where we are in the market right now, I completely reject the notion that we're replacing trust. That's absolutely not true. Anyone who will tell you that has not interesting assets because they don't have access to that and will not distribute anything. That's why I also say when people announce, I'm going to tokenize 10 billion of this, do it. Show me that you did it, but then even show me how much you distribute it, okay? You will not get great assets, you will not distribute them if you don't have trust. If you think about it, that's great news for us humans, because all the processes, all the stuff that's in the execution side will go to machines. Every company, including Evident, is now an AI company. Of course we use AI because we have perfect data. It comes from this wonderful new database called blockchain. So we automate a lot of these processes already. The core of our business is still a human business that's based on trust and respect. That will never change, in my view. So, same way I reject the notion of code is law. It is not. Because law is about interpretation, right? You can write things down, but nothing can be written down in as much detail as the messiness of life. So you always have to have a conversation and interpretation. So I think we should flip that and say some things will not change, and that's trust between humans that really drive business. For us, having done now hundreds of millions of transactions in this space, that's the only way of doing it. And really where we can say automate trustless in the sense of it's correct, that's all on the execution side. And this is really what we're looking at.
I guess I'll take on the investor perspective. Like when we talk about trust and transparency, the service providers that we work with, the trading venues, they are not operating on an equal playing field, or level playing field, because despite a lot of legal frameworks is being put in place in different jurisdictions, a lot of crypto exchanges are still operating on different standards, and it's not as transparent as you want them to be. So, I mean, first-hand experience, we were sometimes asked to pretend that we are a client from their local jurisdiction where they have a license, or we must be onboarded to an offshore entity that they operate that is not the licensed entity. Obviously, that they will have different counterparty risk or investor protection requirement. So a degree of healthy caution is still required when you do investment in a token form. It depends on where it's traded, right? And I think for any organization, like for us as an investment firm, we have risk and compliance teams to launch a new product or invest into a new asset class, be it RWA or just crypto tokens, right? In the mid and back office, their level of understanding for this new risk and what it brings on to the existing system is always quite challenging, because the front office is very keen, but the back office is not as easy to be convinced.
Yeah, absolutely. I do believe that the technology itself is not an issue if it's a trust problem. You see how the AI, the Web 2 that we have been through. But I think the key is really about the accountability, right? So which means that it's just like when you have an autopilot car that you still want someone to sit, like pretend that someone is really driving. It's about the high touch feeling on that. And also, for example, institution or even family offices like ourselves, I believe that sometimes it's even if something go wrong, you have someone to sue, right? You got someone to really talk to and see them. So the trust, I think, is the technology itself is all obvious. Like from day one, smart contract, automation, everything, I think it makes sense on blockchain. And ultimately, even no matter how good the kind of underlying or the kind of real-world asset that we're talking about to be tokenized, you still need someone that actually have the due diligence process behind on that. So definitely, I do not think it's a problem of technology.
Thank you. We had some interesting discussions in the panel before around liquidity. I think we all understand this is an important part of it. So the promise of RWAs is essentially instant liquidity for traditionally very illiquid asset classes like real estate, for example. A token, however, is only as liquid as the market behind it. So what steps are we taking to actually really create that depth in liquidity? Ray, do you want to kick us off?
Yeah, absolutely. I mean, we talk about real estate all the time, and we always argue this, right? Tokenizing real estate, would that become a Tesla stock today that trade, on that volume? No, right? It won't help. It might help to fractionize, cutting the smaller pieces on trading, but ultimately it's the underlying asset itself. So, I mean, by the numbers, obviously, the past 2 years, if I'm not wrong, it's actually go 4 times the whole RWA world, right, in terms of the whole volume. So it actually makes sense. And another example can give you, I think Peter just mentioned about PE on that. So under our Revo, right, so we do have private equity investment. So some of the project that we did, actually, it's a single project. So recently, I'm sure everyone heard about it, the Anthropic, right, for example. Anthropic as a company, we get it in Series D, which is much, much lower valuation. Right now, they just completed another round of $315 billion US. There was a time that actually we have been asked, hey, do you guys want to tokenize the shares or the funds that we hold? I said, yes, of course. Why? Because ultimately, you have to market make it. You have to have demand and supply at the same time, but not just creating a tokenized RWA doesn't mean that you can create liquidity. So I'm saying that we have family invested into this project, but in Singapore, maybe in Hong Kong, even in China, there's someone that wanted to invest into the same project, but they're willing to buy in a maybe higher valuation. So I told them, hey, even within ourselves, that we can make this happen. The problem sometimes that we see still nowadays is how do you actually get operational? How do you actually get execution done? No, I do think that you guys are expert in this because you guys are tokenizing everything on that. But the fact that is what we see, even if we have this market making possibility, there's still a gap in there. Which, for example, how do you reflect the price of this kind of secondary price, that illiquid asset? That after trading, how do you reflect on the NAV? So things like that is still something that we're trying to figure out as well, to be honest. So I think, so the key is not really about tokenization. It's really about where the supply and demand is and where liquidity brings in.
Gillian?
I fully agree that tokenization itself doesn't change the nature of the asset behind it.
Yes, just to add to that, so it does change the nature of the asset in a very important way. I tell you why. Tokenization does not lead to liquidity. I think we all know that. That was very clear from the very beginning. But what you can create is new liquidity mechanisms. And those liquidity mechanisms can be utilized to create liquidity. That's what we are doing. I'll never name any assets that we invest in, but some of them have been named before that we also participated in. And so all of a sudden, you tokenize a private equity stake. Someone participates in that round, and even a $10 billion round in AI today is sold out in like a month. And someone says, oh, I also wanted that. And we say, okay, you can create an offer on our secondary market and buy it from someone who participated in that round. And because it's so easy for them, and because we solve this problem of clearing and settlement, everything that's pre-trade checks, post-trade, you have automatically more liquidity, right? So the mechanism lead to liquidity, but the mechanism is used for participants to get more liquidity. Because one thing is very clear, there's a huge demand for liquidity. Now, second thing I wanted to say is, let's clarify what we mean with liquidity. I think I'm not technically from the crypto industry. I'm a TradFi guy. So I think what was a wrong expectation from the crypto industry was to say, oh, we're going to move these assets on chain, and then we'll see like deep liquidity pools like in crypto. That's wrong, because the two asset classes are fundamentally different. Crypto has its very own liquidity profile, its very own velocity of markets. You can talk about that for a long time. Private market assets, like the ones we tokenize, have a different profile. And the way to illustrate is I learned that from one of our clients, someone in a family office. She said to me, look, Florian, I'm not looking to trade these assets. Why would I? This is a great asset. I want to hold it. But what I want is to rebalance my position. What does rebalancing my position mean? It means moving from a multi-year liquidity window. I have to hold this thing for 5 years. If you invest into a private equity fund for like 10 years or 10 plus 1 plus 1, 12 years, that's crazy. So I want to move from a multi-year liquidity window to, let's say, a multi-week liquidity window. So I create this offer to sell my position, and someone buys it 3 weeks later. I'm super happy about that. That's what we mean with liquidity in private markets. And that's something that we see on our platform now, basically every day. These transactions are market clearing transactions. Last point, on pricing. Again, I'm an economist. By the way, what brought me to crypto actually was, I'm from Austria, so Austrian School of Economics. It's very much about market. So if you ask me, what is Anthropic worth? I look at the last traded price. Someone put money on the table at that price, that's what it's worth. You can do your net asset value and your analysis and all that stuff. No. What are people trading it at? So I think that will fundamentally change, because today the auditors say, hey, wait a second, we need to do our analysis. I say, just look at the market price, right? There's decent liquidity in this thing. That's what it's worth because the market said so. So I guess the point is, because you now have liquidity mechanisms, a lot of interesting things happen to that asset class that were just not possible before, and it would change the industry fundamentally.
I think we all agree that indeed blockchain itself naturally brings a benefit associated with blockchain, right? And indeed, what we say that when tokenization as a technique, that doesn't change the nature of certain, meaning that it doesn't change the core valuation drivers of the set and demand and supply dynamics of which.
100%.
If you tokenize a real estate whose price doesn't get repriced every so often, neither the income stream associated with that, right? So people don't come to speculate and trade it. But if you're tokenizing what, like Craig said, OpenAI or SpaceX equities, let's say private-owned equities, right? Naturally, there is a natural demand for people who come and want to trade it. So I would still argue that indeed, tokenization itself brings you to new venues, but you still face the same investor base who will want to trade the thing that they can have speculative value. Like recently, a lot of exchanges started to list commodity-based tokens, and those have very good liquidity.
Do you have anything to add, Peter?
I'll make an analogy to let's say, the typical market-making model in the bond market. So the point of the business, it needs to have volume. You underwrite the risk. I guess, Florian, you anyways have to underwrite the risk. This is the first step, yeah? Before you underwrite the risk, there is no market making. Otherwise, it's a questionable business model, and it's a high degree of risk. So once you underwrite it, the question is, why do you want to do it? In a typical world, they would just capture the spread because there is a secondary market, and that's a separate, let's say, niche of capital providers, usually large banks that do that and make their margin. On chain, I think this type of balance sheet is not available, I would speculate. So the platform has to take that role of being that balance sheet to make their product more competitive, offer this to the market, and if I understood correctly, that's exactly what you described. So it's a different because their specialization is not yet there. I guess that just not enough time passed. different platforms decide what they're going to do to make their product better. So it's we all are in agreement. So the tokenization of a liquid asset on chain does not bring liquidity. End of the story. And there are different ways of doing the cheaper, faster, clearly, right? But it's a matter of But overall, I'm very happy to hear that industry is going towards completely consciously towards better quality products, either way or another. We're talking about this now. In 5 years, the market will be much more efficient for sure. Maybe we'll even have balance sheet backing that up.
Sounds good. Let's move on to the regulatory side of things. So Hong Kong has worked very hard to become a global hub for digital assets. For global investors that you're working with, how important is that? And how much does the Hong Kong stamp of approval add to things in comparison to, for example, New York, London, Singapore? Gillian, do you want to kick us off?
Yeah, sure. Since we are licensed here. Actually, our compliance officer has some phrases to define certain regions, like Hong Kong, Singapore, UK, London. It's called 强监管, so strongly regulated or heavily regulated. And they also have a phrase for the places such as Cayman Islands, BVI, or Bermuda, including the Middle East, what you call light touch regulation. Sorry. So when we are paired against, let's say for client base, where we speak to, whether we're licensed in Singapore or in Hong Kong, it probably doesn't really make a difference unless they have some of their own preference, be it for regional communication purposes or language or whatever. But if we're paired against with a BVI-approved manager, then obviously the investor will understand the stronger set of compliance burden that we have to go through means better investor protection and their asset protection for them. So it does move a needle in a certain sense.
Ray?
Yeah, I do have bias. I was born and raised in Hong Kong. But I mean, seriously, I do believe that Hong Kong has been really doing a good job on that. So, well, I mean, as a group, we are fully licensed under Hong Kong, Singapore as a jurisdiction, or even MAS we have been dealing with. But in terms of the, particularly on digital asset or tokenization, I do believe that Hong Kong is really doing well. Recently, actually, we have been also granted the Type 4 and 9, a very typical one that can deal with 100% digital asset in Hong Kong. But I think more importantly is even we are stepping up a little bit on what we were doing about the fund management, but also becoming even more like the external asset manager, doing like working with different counterparties, which is also fully licensed. I think that the key for that is because from the clients or from the institutional perspective, regulation is something that you cannot ignore, basically, right? So I think when we position, the headquarters, when we position, how do you put the compliance, it's really important to be again credibility, so that we can move to the real, setup and provide a solution for the client.
Yeah. So for the way we operate, being licensed is the price of admission. It's that simple. So we started the licensing process very, very early. We were the first in Hong Kong to get that license set up we have today. So issuance of tokenized securities, distribution as a broker-dealer in primary markets, running a secondary OTC market, and trusted custody services. So taking in client money, custodying assets, etc. So it's all under SFC supervision in one setup. I'm also biased. I've been here for a while. I'm double biased, I guess. I've been here for a while. I also had the honor of serving on the FinTech Advisory Board of the SFC in Hong Kong. Being a regulator is an impossible job. It's impossible because you're basically incentivized that nothing blows up. So basically the smartest way is not to change anything. No innovation. But then at the same time, we need to show innovation as a financial center to stay a leading financial center. So it's very difficult to strike the right balance, and I've seen that from the inside. Hong Kong did an amazing job of striking that balance. So where are we today? The rules are super clear. They have been clear in our space, tokenized securities, more or less since 2024. Then you're adding small details, and we will add more details, but at the core, super clear. Number two, very strictly regulated. we're still the only one with that setup in Hong Kong, right? It's not easy to get these licenses. They're building, I say, a high fence, which is great for companies who have it because it's incredible competitive moat and a defensible model. And number 3 is really thinking about what's next. So if you listen to the regulators, they do their speeches at consensus, they have the right ideas. They say, this is not about tokenization anymore, because that's done, right? We can tokenize, people tokenize. Now it's about 2 things that are actually really critical: distribution and liquidity. So how do we connect liquidity venues together? That's what they are thinking about. So again, a step ahead. So I would say Hong Kong has been a step ahead regulatorily for years now, thinking deeply about this, and I think the secret was engaging with the industry. They're hyper engaged. We talk to the SFC basically every week. First of all, we have to report all of our assets to the SFC, but it's an exchange, and I think they do that with a lot of partners. And then you hear some criticism from other parties, mostly because it's hard. Yes, but it should be. We should have a difficult environment to protect, in the end, investors. So I think if you, maybe as a last point, if you think about that from a company perspective, what do you want? You want a tier 1 financial center, okay? You want rules that are clear to you so you can leverage them and set up a business within these rules. And then, especially in our case, you want a deep capital market. If you have these 3 things, then you have a chance of building a great business. I think Hong Kong has also shown over particularly the last 2 years where things really picked up in public markets, but also in private market investing, that is a great place. We just crossed 3,000 family offices in Hong Kong, right? You serve some of them as an MFO or as a digital FO. We serve some of them. It's a fantastic market with a really strong regulatory framework.
Peter, do you have anything to add?
Yeah, I mean, well, I'm not from Hong Kong. I'm not going to be entertaining you with Luxembourg law and regulation today. But the fact that we're here, we very much appreciate the fact that, you know, it's a hub that is investing proactively in becoming the world-class, you know, facility provider for investors, and high barriers for entry to you guys means that you will be very mindful which projects to onboard. So, you know, by nature of things, only good projects would be onboarded. I think it's a great combination of the 2.
Thank you. Florian, you mentioned distribution, and obviously part of the topic today is about retail investors. So are we really actually creating an investment asset class that's available to the retail investors to invest into private equity, to real estate, or are we just kind of repositioning this as another way for the 1% to get access to these kind of deals?
It's timing. So again, I try to take the macro view, and then you look at where are we in the cycle. We're still at the cycle where this is about making things more efficient to investors that are relatively higher in that pyramid. So our clients are basically all, well, first of all professional investors, and then all people who have a lot of money. And they just want more efficient access. They want the liquidity we can provide, and they want convenience. So one thing I learned, again, rookie mistake as a founder, you think about yourself, and this is what your clients want, is that I thought, you know, you take these kind of big investment decisions, you want to look at the big screen and read the details and click on the right buttons. But then we saw in the data, most of our clients just do everything on mobile. So it's that convenience aspect is very important. So I guess my point here is that right now, it's too early for retail, at least for the traditional, for this type of assets that we have. Because you also have to think about, if you've never had access to this type of assets, there is an educational component. You need to explain to people that these assets tend to be riskier, they behave in different ways from, let's say, public stocks, and so on. So that's a duty, I think, on the platform side that you do that. Second, the regulators are not quite ready for this yet. So they want to, in Hong Kong at least, they want to take it step by step. Okay, you get your license, PIs only, make sure nothing blows up, and then maybe at some point we can discuss it, right? So of course everyone is looking at that, and to me, that's the natural place we will go, 100%. We will invest very small amounts into private companies, absolutely. But we're not there yet in terms of market readiness, even investor readiness and regulatory readiness.
Gillian?
Yes, so At the moment, the principle is that the tokenized securities or RWAs are accessible for retail if the original version of the underlying asset is. Suppose the ETF token or based on SFC public authorized fund, then retail people are able to participate. If it was only meant for PI investors, meaning the product itself was more complex and more volatile, then by nature, the tokenized version is also only accessible for PI. However, like globally, we can see the trend is slowly moving towards everything on chain, right? We know New York Stock Exchange is planning to adopt blockchain as infrastructure, so they could just trade stock tokens, right, 24/7, and issuing IPO in native token form. Of course, we're still a little bit away from that, but once and when, right, such convergence become more tangible, we have seen a lot of crypto exchanges started to move first and launching various all sorts of their own designed so-called right, security or RWA tokens representing or replicating stock performances. However, those are not registered tokens because they had to somehow design into a non-security token or utility token or swap token or however you may name it. But at the moment, those are not efficient. It's not fungible because the same Tesla token on Binance is not interchangeable with the same token on Ondo or on Kraken or whichever other platform that you trade with. And none of this token is able to be settled against your traditional brokerage account. So that is not ideal. But with what is happening right now, like with the both forms trying to achieve going closer to each other, we can see one day that regulatory requirements is mainly around KYC and AML. If, let's say, we as investors collectively all have verifiable on-chain IDs, that maybe KYC is enforced on the DeFi app layer, then we will have the RWA tokens that are able to be enjoy DeFi composability and bring some additional earning yield potential for token holders, where you could stake, restake, right, and you could provide liquidity for RWA tokens, and that's when that we can hopefully see a lot more capital flow on chain, and retail investor will also be able to enjoy, right, more benefits that RWA will bring.
Well, I might not be in the best position to talk about the retail, right? But I can definitely say that I do not think that it's going to be a very fast pace of getting them to access into somewhere that they couldn't access before, because there are lots of regulation hurdles, there are lots of education that has to be done. I do believe that there's company trying to do the PE funds, kind of spreading into the retail by selling on the smallest pieces in the even Web 2 world. But I think for the more institutional and family office point of view, I believe the tokenization at the end of the day is really about also making the underlying assets more efficient. It's about let's say I'm pretty sure that my CIO wanted to have more efficient way of handling the collateral, right? More easier to access to T-bills that actually trade T plus zero 24/7, because the mass market won't trade 24/7, right? I mean, if they want, they become traders, right? So ultimately, it has to be from the institutional first to have this adoption. And more importantly, I think what we see in the past 2-3 years is because the industry has changed a lot, which means that I don't see any, I would say, trend or upside on the whole kind of digital asset markets. But RWA itself, it has a great opportunity, as the penetration is still very low, and also the infrastructure itself. We also mentioned that we always wanted to buy the T-bills, tokenized T-bill. However, there's no such one single platform to be done. So one thing that I would definitely see in the future, maybe 1 or 2 years, is consolidation of the industry, which means that people trying to do similar things. So we have our client, AUM, everything. We want to pull things together, make it happen so that the distribution is really done, but not distributing. It's about the execution that we mentioned always.
Yeah. You want a conspiracy theory or a regular view?
Let's go with conspiracy theory.
I knew you were going to choose that. Just for fun. I'll give you both. Obviously, retail funds, deposits of the banks at zero interest rate. But on the other hand, I mean, I can again say from your perspective, but I think it's regulators align. It's a very sensitive topic because there's so many fraudulent schemes, and this capital, from the social, let's say, welfare perspective has to be protected. That's much more important than making a margin on it. I personally agree to that completely. The key element here is the control of the gatekeepers. So if the gatekeeper is, eligible, reputable counterparty through the licensing, I think it's going to be great if the access is granted. But that puts enormous pressure on the gatekeepers. So I'm personally in favor of making the amount of gatekeepers, grow in size, not only the banks to be the gatekeepers, but this process takes time. Everything which is quality takes time. And we can see the same here.
Sure, thank you. We're getting towards the end of the panel. I think an interesting closing question to ask will be, if you can give one piece of advice to either institutions or investors who are considering bringing more wealth on-chain in this current environment, what would that be? Peter, do you want to kick us off?
Yeah, sure. Invest in LynxCap tokens.
Thank you.
So
I had to say that.
that's why you're on this panel, Peter, for that last comment. No.
That's why I came to Hong Kong.
That's why we met, Peter. So, no, in all seriousness, for us, it's look for quality, right? Be discerning. Go to the licensed players. Go to the best quality asset. Look at the structure. Does it make sense? Pricing, fees, the layers of that. The usual stuff doesn't go away. I think we all agree on that. I totally agree, right? So those are still the same things. They don't change just because the format that you're interacting with is digital.
Speak with people with the right knowledge, do the research before making a move, because you really need to understand what's the purpose of moving on chain or investing on chain, right, before you start to implement it.
I think in a few years' time, there may not be any topics about like just RWA because it's so common already. Everything should be on chain. Everything is stable coins connected. Everything should be convergence in the same place. So get yourself prepared, get the right institution to help you to be able to execute. As we mentioned, the key point on that is how do you actually do the first step and make sure that you have access to all this. So going through an institution that have these capabilities is very important.
It's a really interesting point that you've made, that last one there. Do you think we're even going to use the phrase blockchain or RWAs in the future, or is it all just going to become part of the same system?
The way I always put it is, to know that this industry made it is that we will not talk about it. Just like you don't say, I'm using Internet Protocol v6 to order food. No, I just order food. We'll also not say DeFi, TradFi, it would just be Fi, right? So, and I totally agree. I don't know what the actual horizon is, but let's say 2-3 years, we'll not talk about this stuff. And by the way, just to close that, from our side, our clients, they don't care that it's tokenized. Sometimes they bring it up, we don't bring it up. No one cares, it's just a form of database for most of these clients. What are the benefits, right? So I think if we get to a point where it's not a topic anymore, that means we're heading in the right direction.
Agree that in the end, everything will be on chain. However, there will still be distinction between security token versus payment token versus meme coins. So I guess RWA as a phrase may still exist for the next 3 to 5 years, but it might disappear in the end.
Any other comments? Okay, we'll leave it there. Thank you very much to the panel. Thank you, everybody.
Thank you very much.
All right.